Every year around this time, the same stale headlines start circulating across crypto Twitter and finance YouTube. Sell in May and walk away. The data behind that saying, though, is mixed at best, and as a standalone trading rule, it's barely worked for stocks over the last 100 years, let alone for Bitcoin more recently. But May 2026 is different, and not because of seasonality. 7 separate catalysts are converging into a single 30-day window, with Bitcoin already down nearly 38% from its October peak and Ethereum sitting more than 52% below its highs. The most consequential crypto bill in US history is dying in the Senate, the Fed chair conversation is reshaping rate expectations, Warren Buffett is sitting on the largest cash pile of his career, the geopolitical environment is anything but calm, and much more besides. So today, we walk through every one of these catalysts, what to actually watch, and how to think about positioning into the most loaded macro window crypto has faced in years. My name is Guy, and you're watching The Coin Bureau. Now, let's clear up the seasonality question quickly, because it deserves to be addressed before we actually get to anything that matters. Across the last 20 years of S&P 500 data, the November to April window has averaged roughly 5.96%, while the May to October window has averaged 3.78%. Both halves are positive. The gap is real but narrow, and it does not survive transaction costs, tax friction, and the risk of missing the best trading days of the year. For Bitcoin, the saying falls apart even more completely. The average May return for BTC across the last 12 years is approximately 11.6%, with 7 of those 12 years finishing positive, and the May to October window has averaged a remarkable 46.9%. Even Bank of America's analysis of nearly a century of S&P data has concluded the model is unreliable as a trading strategy. So, put simply, sell in May is statistical folklore with a real but narrow effect, not an actionable rule. But May 2026 deserves attention for an entirely different reason: the unusual concentration of real macro catalysts hitting crypto in the same 30-day window. And this brings us directly to the most underappreciated risk for crypto specifically, the slow-motion death of the Clarity Act in the Senate. The Digital Asset Market Clarity Act passed the House in July of 2025 with a bipartisan vote of 294 to 134, which is an extraordinarily strong margin and a rare moment of alignment on anything crypto-related. But it's been stalled in the Senate Banking Committee for the better part of 9 months, hung up primarily on stablecoin yield provisions that the banking lobby argues mimic uninsured deposits. Polymarket odds for Clarity passing have collapsed from highs near 90% earlier this year to as low as the high 30s by late April, before partially recovering to the mid-50s following a compromise text from Senators Tillis and Alsobrooks on the 1st of May. Senator Bernie Moreno has issued a public end-of-May ultimatum, and Cynthia Lummis has warned that missing the Memorial Day window could push the next workable alignment of House, Senate, and White House out as far as 2030. Now, you might assume that a bill with this much bipartisan support and this much industry pressure simply cannot fail. However, that assumption ignores the Senate calendar. The practical markup window closes in mid-May, the recess begins on the 25th, and after that, the midterm cycle starts swallowing every available legislative day. If the Clarity Act dies in this window, then comprehensive market structure legislation pushes deep into 2027 or beyond, and the industry returns to regulation by enforcement. Furthermore, sitting directly on top of that legislative cliff is the Fed chair conversation, with Kevin Warsh's confirmation hearing reshaping monetary policy expectations heading into the summer. A more hawkish than expected confirmation tone is bearish for risk assets including Bitcoin, while a dovish surprise is the opposite, and either way, the binary lands inside the same loaded window. You see, crypto is rate sensitive in both directions, and a leadership transition at the Fed during a period of unresolved inflation signals is not the kind of backdrop that produces calm price action. And if you want to trade these catalysts in real time as they actually move, then our completely free Coin Bureau weekly newsletter is the place to be. We cover the most important stories in crypto there every week, and the link to sign up is in the description below. Now, the third risk in the stack is what economists are openly calling a white-collar recession, and the data on this one is alarming. The first quarter of 2026 was the worst for tech layoffs in years, with over 81,000 announced cuts spread across Meta, Microsoft, Google, Amazon, and the broader sector. And yes, AI is the culprit. Microsoft is down roughly 14% year to date, Meta is down nearly 8%, and even with the recent 30-day bounce across mega-cap tech, the only name still meaningfully positive on the year is Google. Now, this matters for crypto because tech workers are disproportionately overweight digital assets, they carry the largest mortgages in the country, and they drive consumer spending in major US cities. So, forced selling from laid-off workers covering living costs is a real liquidity drain that does not show up in the headlines. And this brings us to catalyst number 4. Warren Buffett's Berkshire Hathaway is now sitting on roughly $373 billion in cash and short-term treasuries, the largest defensive position of Buffett's career. The cash hoard has nearly tripled in 3 years, jumping almost 100% between 2023 and 2024 alone. Buffett has only positioned this defensively twice before, pre-2000 and pre-2008. Both times, he was right. So, this isn't to say that Buffett has any opinion on Bitcoin specifically. The signal is that the most respected long-term capital allocator alive sees no acceptable risk-adjusted opportunities at current valuations across the entire market, and crypto is necessarily included in that. Layer onto that the fifth catalyst, the risk of ETH Treasury companies unwinding. Bitmine Immersion, the most aggressive ETH Treasury bet of the cycle, is now down more than 86% from its 52-week high, with paper losses on its ETH stack estimated in the range of $6.3 to $6.5 billion. SharpLink, the second largest ETH Treasury vehicle, is down approximately 94% from its highs, and has just terminated its discretionary asset management agreements with Galaxy Digital and Parify Capital, effective the end of this month. The brand new Ether Machine SPAC, a $1.6 billion deal designed to launch yet another ETH Treasury vehicle, meanwhile, collapsed in April due to what were politely described as unfavorable market conditions. So, concentrated single asset treasury structures behave the same way under pressure that Three Arrows and Celsius did in 2022. Same direction of risk, just a different mechanism of failure. And the sixth catalyst is perhaps the least obvious one, Morgan Stanley's risk disclosures. Morgan Stanley launched its Bitcoin Trust in early April at a 14 basis point fee, the lowest in the category, and recommended a 2 to 4% allocation for wealth clients. But the prospectus they filed is genuinely extraordinary. Explicit warnings on market manipulation, custody risk, flash crashes, regulatory exposure, partnership failure, and even quantum computing eventually breaking Bitcoin's cryptography. It's one of the bluntest institutional risk documents Wall Street has ever published for a mainstream crypto product, and every other major wealth manager is going to be forced to publish something equivalent in the months ahead. Which finally brings us to the geopolitics sitting underneath everything else. The US-Israel conflict with Iran is now in its 10th week. The Strait of Hormuz has seen traffic drop more than 90% since the war began, and Brent crude printed an intraday high above $126 on the last day of April, the highest level since 2022. Energy prices up 60% in 3 months are a direct consumer tax that complicates every easing path the Fed might wish to take. And on the regulatory side, South Africa just published the most aggressive crypto capital control framework any major democracy has produced, with private key surrender powers, forced sale provisions, and penalties of up to 5 years in prison. The comment window closes inside this same 30-day window. Now, each of these 7 catalysts is independently manageable. but layered on top of each other means we're looking at a lot of risk out there in the market. For you, the practical implications are specific. Position sizing matters more than usual when realized volatility is likely to spike. The consensus from professional trading desks for windows like this is to risk somewhere between 0.25% and 1% of equity per trade, and to compress leverage well below 5x if you're using any at all. Cash on the sidelines is probably a good idea at times like this, as it gives you the option to make a move if the market does plunge on one or more of these catalysts. Self-custody decisions become more relevant if exchange flows get stressed or if other jurisdictions follow the South African template. So, lots to watch out for over the coming weeks, suggesting that May could be more interesting than the old saying suggests. All right, will the convergence of these 7 catalysts force the kind of cascade event that defines the rest of the cycle, or will the market absorb every one of them and grind sideways into summer with the macro narrative intact? Let me know exactly where you stand in the comments below. And if you want to understand exactly how the Genius Act stablecoin framework is being woven into the same regulatory architecture that the Clarity Act is supposed to complete, then you should definitely check out our full deep dive on that legislation right over here. Okay, thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.